Welcome to Ahead of the Curve. I'm Susan Lisovicz. Today we're focused on the European debt crisis and why it might be much closer than we think. Here to talk about it is Stanley J.G. Crouch. He's the CEO of EXP Wealth Enhancement, which is part of Aegis Capital, where he's also Chief Investment Officer. Welcome, Stan.
Thank you, Susan. It's great to be here.
You paint a really bleak picture of what will happen if Europe doesn't get its act together. Why?
Well, there are two ways I think the euro can go from here. One way, which is the negative way, is the disorderly breakup of the currency union. The other way would be a more orderly breakup, but I believe that there is going to be basically a new currency or basket of different currencies coming out of Europe.
Okay, but the fact is, in the meantime, there's a lot of fear, there's a lot of instability, and it's playing out in the U.S., and it will have direct impact on the U.S. What do you think could happen? Could it be a double-dip recession? Could banks be once again on the brink? Could our ATMs not work? What do you see?
Well, I don't think the ATMs won't work. There is a lot of relationship, though, between the financial institutions here, our large institutions particularly, and the European zone. I do believe, though, besides the financial integration, what's really more concerning is how does this impact the world economy? Because in my view, we should make no mistake. Post the WTO in 1995, we are a globalized economy. There's no us and them anymore. So anything that affects a region as important as Europe in the negative sense, lowers growth or even creates some contraction in their economy, spills over to everything.
Right, but what does that really mean? Because I think Americans of all economic brackets right now are focused on better pay, more work, a better sense of how we're doing. So what can Europe do while it's trying to figure out its problems? How are we so interrelated? What should we be looking for here?
Well, I think what we should be looking for is a real plan. Now, supposedly this latest iteration of the summit, after endless summits they've had over the course of the past couple of years, will yield a plan to have what's known as a fiscal union. They already have a monetary union, meaning they share a common currency. What was lacking in the beginning, formulaically, and in the real strictures of how the euro was put together, was this idea of fiscal unity. So each government decided how to tax and how to spend. And what's happened is that's become very problematic because other economies, they're not all doing the same. They don't all have the same cost basis, they don't all have the same efficiencies, and they don't even have the same policies. So it does create a real problem. And this is basically fundamentally a math problem. It's an imbalance that's really been there from inception.
Right, but U.S. banks or U.S.-based banks have also become part of it because they've been buying this sovereign debt that was highly rated. So they're going to be in trouble. You're already seeing it play out, yes?
Well, there are sovereign debt holdings in some of the banks here, but there's also institutional holdings, not just of sovereign debt, of some corporate debt in Europe, also equity. Because if you're a portfolio manager in, say, a pension fund or an endowment or even some mutual funds that are set up to own, say, world market indices of either bonds or stocks or a combination, you have to give what is effectively the world's largest economy in Europe a weighting that is basically reflective of its economic power. So we are infused. It's not always on the surface, but really what's more insidious to me and more dangerous and very hard to quantify is what about the derivatives? What about things like credit default swaps, contracts, insurance policies that were written on the outcome of debt that was considered riskless?
This is shades of 2008 all over again. Weren't we supposed to have resolved this? This is way too soon for this to be happening again. And the system still seems to be quite fragile.
It sure seems like it's too soon. But if we think about what happened, and I have firsthand knowledge of this, the European banks came to the U.S. market in a very big way as lenders in our property complex, meaning they funded project development in big developments of single-family homes, for instance, or multifamily projects or senior living projects, large real estate, commercial projects, office buildings, malls, etc. They wanted to be in this market. They came in late, sort of almost at the top, and they came in with both feet. Now, when the crisis really unfolded and it started to come apart in 2007, and that rolled into the Lehman demise in 2008, and then everything stopped, the European banks retrenched. They pulled back to Europe. Their governments basically ordered them to do so. They went back to Europe and they said, wow, that was a real mess. And we still have the mess because they're still here unwinding their situations. But the governments and the banks decided we're not going to take that risk going forward. We're going to buy sovereign debt, particularly in the Eurozone, because it's riskless. Governments won't default. And we're going to buy high-grade corporate debt, which actually tended in a large way to be each other's bank debt. So it's an incredible triple whammy at this point.
It's sort of like what happened with the housing market. Well, the housing market was going to continue to be a very sound investment. But I see two problems here. One is that not only are U.S. banks now invested, and institutional investors, pension funds, whatever, invested in Europe, but if Europe slows down, and it is slowing down, Europe is a big buyer. The European consumer is a big buyer of some of the things that America still exports.
Yes, Europe's an important export market for us, and it's a very important market globally again. Remember, we're all connected. For instance, the largest market for China is not the U.S., which is really against common wisdom. The largest export market for China is, in fact, the Eurozone. And Germany, of all things, happens to be a net. In other words, when you balance imports against exports, they happen to be a net exporter to China because they make some very sophisticated, one-of-a-kind products that the Chinese need for their industrial, for their industrial complex. So it's really so interrelated and integrated. It's sort of like the old adage, if somebody sneezes, somebody else catches a cold.
Well, it used to be the U.S., right? But now it's Europe, right?
Yeah,
I think we're still recovering from pneumonia from 2008. But actually, you actually say paradoxically that this is a cleansing process, that we've seen it happen historically, that this is actually a good thing?
Well, I don't think it's pleasant in terms of a good thing to go through. And I think that some of the intervention actually exacerbates the problem and extends the problem. Because at the end of the day, it really comes down to quantification or math. Some of the debt in Europe is unsustainable. Greece is at
write it off.
Yes, of course. Greece is at the point where they can't pay their current bills, and they are actually taking emergency financing to operate the government day to day, and a big part of that operation of the government includes paying their bonds. The problem is, I attribute the problem in Europe right now to the credit default swap complex, because I think what's less known to the average person or even market participants is the real nature of the extent of the exposure of credit default swaps. What credit default swaps are basically insurance policies, bets, if you will, proposition bets that a particular borrower will pay off its debt.
Right. We just don't know how many of them are out there.
Yes, but we do have a reason to believe that the notional or total value is multiple times the underlying debt itself. So if you're allowing...
Isn't this what happened to AIG?
Effectively, yeah.
And we know what happened to AIG.
And they did it on mortgages. And I think how the European banks in particular got caught up in it, and our banks to some extent too, they looked at it as free money because they're writing credit default swaps. In other words, the buyer of a credit default swap is betting that the credit will default. The seller or issuer of the credit default swap, generally banks, are betting that the issuer will not default. And since the likelihood as highly rated sovereign debt was so remote that it would default, they didn't collect enough premium. In other words, they collected very low premiums. Think of it this way. Think of it as the auto insurer that insures
an 18-year-old kid.
Well, by extension, what happens is they insure Aunt Tilly. Now, Aunt Tilly's a great driver with a spotless record. She's got all the metrics to be the lowest possible premium. But in that policy, there's a provision that if somebody else drives her car with her permission,
like
they'll
the
be covered too.
Kid.
And that's what happens. The 18-year-old kid ends up driving the car much more than the insurance company thought that they would, and they have a lot more risk than they thought they had.
But in risk, there is opportunity. So let's go back to you as a chief investment officer. Where is the opportunity in Europe right now? Or would you just say to your clients, just stand back and let the dust settle?
Well, I think there's a lot more event risk still to come with European assets, whether they be bonds, whether they be equities. What we do, we prefer to stick with U.S. entities for two reasons. One is that we get a full picture of a standardized reporting system because we're all about analysis. We do very fundamental analysis on everything we invest in, and we invest in only things that we believe are sustainable going forward with high margins for error. So that means we have to be able to trust the numbers. So the one thing we want is what's called GAAP, or General Agreement on Accounting Principles. So that tends to draw us back to U.S. entities. Now, U.S. companies, even though they're domiciled in the U.S., notionally or by incorporation, many of them have so much foreign or international business that you're actually buying a proxy for other countries, and a lot of them are very prominent in Europe. So we participate in other markets really through U.S. multinational companies.
You want to throw out any names?
Well, we don't like to give specific names. We believe in everything in
How about sectors?
Well, we believe in everything as a portfolio approach. So at any given point, and we only buy income-producing, dividend-paying equities as well. We don't speculate on price appreciation. So I would say that there are names that are sort of known to everybody, but let me give you a little reason why we don't give specific names. Let's take a company like Heinz. Heinz is a fantastic company. It's got a great market share. It's a well-run company. It pays a great dividend. It's got a great historical track record of paying the dividend. It's got all the right financial metrics you'd hope for. But here's the problem. If I say Heinz and people go out and hear that and say, hey, Stan Crouch recommends Heinz, let's go buy it. We don't know how much money or whether it's suitable, so people might go out and invest in Heinz just because we think Heinz is good. And what about, remember that cantaloupe problem with the listeria? Well, what if there's an outbreak of listeria in the tomato crop? All of a sudden, we can't take that risk. So what we do is generally own, Heinz could be included for sure, but we own 30 to 35 or so companies that we diversify across different industry groups and sort of that sort of thing because we spread our risk.
But you're still U.S.-centric.
Generally U.S.-centric. We own some foreign companies, but they have to be GAAP accounting standard reporting entities.
So to sum up, Stan, it would be safe to say you're watching with great interest what's happening with Europe, that it will pass over eventually, but there's still opportunities with many good companies based here in the U.S. Would that be fair?
I think that's fair. And the other opportunity is we're advising people to hold a high level of cash because we think between the event risk inherent in the European situation, which is still very much a crisis, that when we combine that with our view, or my view anyway, of the macroeconomic picture, that we are in a worldwide slowdown, that it's a multi-year process of unwinding a credit bubble, that between those two factors, the chances of being able to buy cheaper assets in the near and medium term are higher than normal. So we want to hold cash in case that occurs. So we'd say be higher in cash than normal.
Buy low. I believe it's been a fundamental for your friend Warren Buffett, too.
That's true.
We've been talking to Stanley J.G. Crouch, who is the CEO of EXP Wealth Enhancement, which is part of Aegis Capital, where you're also Chief Investment Officer. And you've been watching Ahead of the Curve. I'm Susan Lisovicz. Thanks so much for joining us.